This video walks through an exercise that tries to match firms from different industries with their financial statements based on our understanding of each firm's business strategy, each firm's industry, and each firm's approach to operating their business. So we're going to be discussing 4 different firms: SAP, a software company; Consolidated Edison of New York, a company that provides electrical and gas services; Novartis, a pharmaceutical company; and Costco, a retailer that offers members low prices through warehouse sales. So here are the 4 sets of financial statements. So we have a company A, B, C, and D, and they each have different gross margins, different net income, different current, long-term, and intangible assets, and different liabilities and equity. Using what you know about the business and industry structures of each of these companies, try and match up the 4 companies with the 4 sets of financial statements. So on a sheet of paper, write down A, B, C, D, and write down which financial statements you think belong to which company. So pause the video here, take a chance to think about what your choices are, and I will reveal the answers on the next slide. So hopefully you've had a chance to take a look at the financial statements that were listed previously and to think about how they might map to the business structures and industry structures of each of the 4 companies that we've looked at. So here we see that in column A, the first set of financial statements belong to Consolidated Edison, the utility company. And one big way to know that it belongs to Consolidated Edison is this business has a lot of long-term fixed assets. If you think of a power utility, they operate power plants, they operate transmission lines, they operate natural gas plants. This requires a lot of long-term fixed assets. So relative to the other 3 firms, we would expect that Consolidated Edison would have the highest percentage of their assets fall into the long-term fixed assets category. In column B, this set of financial statements matches to Costco. So how do we know that this set of financial statements match to Costco? So Costco is a warehouse retailer, and their strategy is to provide low prices to consumers by selling stuff in bulk and through warehouses. So we see that Costco has the lowest gross margins of the 4 companies here. And this makes sense given their stated business strategy is to offer extremely low prices to customers and to make money by delivering substantial volume of sales through its stores. In the third column, this set of financial statements matched with SAP, the software company. And the big way to realize that this set of financial statements matches to SAP is when firms develop their own software or when firms acquire companies that have developed software, this generates a lot of intangible assets or a lot of goodwill. So we see that company C has the highest percentage of goodwill or intangible assets of the 4 businesses being discussed here. So that's how we know that that one is matched to SAP. The other thing that we could possibly use to identify this is this company has great gross margins and has great net income. And so if we think of high margin businesses, historically, we've always thought about software and pharmaceuticals. In the 4th column, company D, we see that this is matched to Novartis. And similarly, we can think of Novartis as a business that spends a lot of time and money on R&D to develop new drugs and to acquire drugs from other companies, so their intangible assets should be relatively high. The tricky part is differentiating between the software company in column C and the pharmaceutical company in column D. You'll notice that they look very similar. However, Novartis has slightly more fixed assets than SAP. If you think about the process of manufacturing pharmaceuticals, you probably don't need as much manufacturing or plants or warehouses as Consolidated Edison or Costco, but you probably need more because you have to physically make medication relative to somebody like SAP, who is just selling software. So the differences in long-term fixed assets, given the margin and net income structure, is what helps us separate SAP from Novartis. Next, we're going to repeat this exercise with 4 different firms and look at some different financial statement information that's going to help us do this as well. So we're going to consider 4 firms: Barnes & Noble, eBay, SuperValu, DuPont, and JetBlue. Sorry, we're actually going to consider 5 firms. So the 5 firms are listed here. So we have a bookseller, an e-commerce retailer, a grocery distributor, a material science business, and an airline. So depicted here are common size financial statements and selected financial ratios. So you're going to want to use your understanding of the industries and the competitive structure that each of these 5 companies operate in to help identify which company belongs to which set of financial statements across the 5. So pause the video here after you've had a chance to review this information and write down on a sheet of paper A through E which company you think belongs to each column and each set of financial statements. When you've had a chance to think about this and write your answer down, come back to this video and I'll show you the answer. So here we see column A is matched with SuperValu, the grocery distributor. Column B is matched with JetBlue. Column C is matched with DuPont. Column D is matched with eBay. And column E is matched with Barnes & Noble. So if we think about SuperValu, this is going to be a business that has relatively lower margins, right? And so one way to think about this is if we look at their gross margins, this is the lowest of all the businesses here, and they have really low return on sales and some amount of inventory. So the other way to think about it is in the in the grocery business, right? This is a business that is predicated on tight margins, so the 4% operating profit makes a difference as well. For JetBlue, JetBlue is an airline. Airlines are also a pretty tight margin business, but you'll notice their gross margins are really high, and they have a lot of PP&E, right? So they have to have airplanes, and so they need to have these airplanes on their balance sheet. So that's how we know that column B is tied to JetBlue. Airlines are also a low margin business from a return on sales and operating profit perspective, but they may have much higher gross margins because airlines don't really have a COGS line per se. Most of their operating costs are going to be just operating expenses out there on the income statement. In column C, this set of financials matches with DuPont. So if we look here, they have some intangible assets and some PP&E, right? So of the 3 remaining firms, DuPont probably has the most PP&E of these firms, but they have higher margins, higher gross margins than the grocery retailer, and higher operating profit than JetBlue, which makes sense. If you're in the business of developing chemicals and these chemicals have patents attached to them, you're probably going to be able to charge a relative price premium for that stuff. Column D belongs to eBay. We know this belongs to eBay because eBay as a marketplace doesn't actually hold any inventory. So inventory is 0. And because all eBay does is match buyers and sellers. It's similar to how Uber doesn't have any cars on their balance sheet. eBay also has pretty high margins because they're essentially going to charge both buyer and seller a fee of some sort to transact on the platform. Maybe it's just the seller, maybe it's just the buyer, maybe it depends on the transaction, right? But their revenue is going to come from this fee for matching the buyers and the sellers. So they don't have to have nearly any inventory, and their operating profit can be quite strong because really what they're selling is the software and the exchanges and the exchange platform to communicate with each other. And that leaves Barnes & Noble as company E. So Barnes & Noble has a lot of inventory, right? So they're going to have a lot of books across warehouses and stores, and that's going to be one way that we can tell that this is theirs. We also know here that Barnes & Noble, when they sell books, they can sit on these books for a little longer. They don't have to turn them nearly as fast as a grocery store who has to sell stuff before things go bad. So if we look at days inventory, Barnes & Noble has the highest days inventory here because books can pretty much sit around and don't go bad. And so that's another clue that the financial statements in column E belong to a bookseller. So hopefully you did pretty well in matching up these firms with their financial statements based on your understanding of the balance sheet items and these ratios and your understanding of the firms and the industries in which they operate in. So the purpose of this exercise is to illustrate how firm strategies and firms' competitive structures and firms' industry structures should be reflected in their financial statements. So what firms report on a financial basis should reflect the world in which they operate and live in. So we'll go through one additional example here where we're going to have more companies, more financial statement data, and more ratios for you to look at. So this is going to be at the industry level. And here we have a laundry list of industries on the right-hand side. We have airlines, consumer product producers, a discount retailer, electronics producers, an executive search consulting firm, a hotel chain, a pharmaceutical producer, a software developer, and a supermarket chain. So pause the video here, take a look at this financial statement data, and see if you can match the industries with the financial ratios and balance sheet data provided here. So these were the answers. Airlines were C, consumer product producer was D, discount retailer was G, electronics producer was column F, the executive search consultant was column H, hotel chain was column B, the pharmaceutical producer was column E, the software developer was column I, and the supermarket chain was column A. So hopefully you were able to match a decent number of these together. And if you weren't, try and go back and think about how the financial statement information presented helps to identify the industry, given what you know about the industry structure and the competitive dynamics in these industries. The purpose of this exercise across the three examples is to illustrate how non-financial items like a firm's competitive dynamics and the world in which they operate should be reflected in their financial statement data. So when you're thinking about a firm and looking at their financial statement information, it's important to keep in mind the context of the world in which the firm operates. It's important to understand the strategy of the firm, the industry dynamics, the trends that are going on in and around the firm that you're studying. So this just helps to highlight how important it is to also develop that thorough understanding of the context surrounding each firm that you're considering analyzing as an investment. And that concludes this video. So hopefully this walkthrough helped you get a feel for how we can link the financial statements and what we observe in the financial statements in terms of patterns with the industry and company specific trends and competitive forces that they face.